Good morning and welcome back to WildPod X. This is Tony. Today is 5th of February 2025. We've got a lot to cover, so let's get right in. Bitcoin is currently trading at $98,000, hovering just below 50-day EMA. We've seen Bitcoin struggle a little bit to reclaim the psychological $100,000 level. Yesterday's trading session saw Bitcoin briefly dipped to 96,000 range before bouncing back. Ethereum has been following a similar trajectory, but it's been slightly weaker in its rebound, currently hovering around the 2,700 mark. The market is still trying to recover from last week's sell-off. With Bitcoin consolidating below the 50-day EMA, we have to prepare ourselves if we are heading for another retest of support zone around 94,000 to 95,000 level. The Fear and Greed Index has dropped slightly, signaling increased caution among investors. Let's take a look at today's morning deep dive. Today we'll talk about M2 money supply, a fundamental economic indicator that directly impacts liquidity in the financial markets, including cryptos. So what exactly is M2 money supply? It is a measure of the total amount of liquid money in circulation, including cash, checking deposit, and easily accessible near money asset like saving account and money market fund. Unlike M1, which is strictly cash and checking deposit, M2 include assets that can be quickly converted into cash but aren't immediately liquid. So why does it matter? Because M2 money supply is one of the best indicators of market liquidity. When M2 is expanding, it means there's more money flowing into the economy, making it easier to borrow, invest, and spend. And when it contracts, liquidity tightens, and we see markets struggle due to reduced access to capital. Now here's an update. M2 money supply is currently expanding at 3.9% after experiencing its deepest contraction in 65 years. This is a constructive development for the financial markets, as an expanding M2 usually translates into improved liquidity and more capital flowing into risk assets like stock and cryptocurrencies. And for the crypto market, an increase in M2 is very bullish, as more liquidity means more money could flow into Bitcoin and other altcoins. Despite the markets looking a little shaky recently, this could be laying the foundation for the next leg up. Now let's take a look at today's top news. In a significant development, the U.S. Treasury Department is facing a lawsuit filed by 3 federal employee unions. The lawsuit alleges that the Treasury Secretary unlawfully granted Elon Musk's Department of Government Efficiency, DOGE, access to sensitive financial and personal data of millions of Americans. This data encompasses social security numbers, date of birth, home addresses, and bank account information. The union argued that such access is both massive and unprecedented. Violating federal law designed to protect individuals' privacies, they contend that individuals should not be compelled to share their personal information with Musk or his DOGE team. The lawsuit also highlights concern over the potential misuse of this data, especially given Musk's stated intentions to identify and eliminate government inefficiencies, which could lead to significant federal spending cuts in response to mounting concerns. President Donald Trump clarified that Musk's role is advisory and that his activities within the government are subject to White House approval. This situation has ignited a broader debate about the balance between government transparency, efficiency, and the safeguarding of individual privacy's right. The second news, crypto exchange Kraken just secured the MiFID license, allowing it to expand its derivative offering across Europe. This is a significant move considering the increasing demand for regulated crypto derivative trading. Derivative has been a huge part of traditional finance for years, and as more institutional investors enter the crypto space, having a regulated platform in Europe could be a game changer. This also put Kraken in a stronger position to compete with Binance and Coinbase in the European market. More access to derivative trading means more liquidity in the market, but it also means increased risk, especially for retail investors. Leverage can be a double-edged sword, and we've seen countless liquidation in the past few weeks due to the over-leveraged positions. I personally strongly recommend against it for everyday investors. The third news, Ethereum is set to undergo another potential change, as more than 50% of validators are signaling support for increased gas limit. If approved, this could allow more transaction per block, potentially reducing fees during high traffic period. While this all sounds very good, it's not without risk. A higher gas limit means bigger blocks, which could lead to increased centralization concerns as it becomes harder for smaller validators to keep up with the network. Ethereum has struggled with gas fees for years, and while scaling solutions like Layer 2s has helped, the core blockchain still needs improvement to handle massive adoption efficiencies. Ethereum's network congestion has been a long-standing issue, and any changes to gas limit could have a significant impact on transaction cost and usabilities. If the approval moved forward, we could see a short-term drop in gas fees, but the long-term effects remain to be seen. That's a wrap for today's episode. Subscribe for daily crypto updates. Stay invested, and I'll see you tomorrow.